Hi everyone. In this video, it's going to be somewhat of an analysis video, but it's also some education in here as well. So, I would like to highlight the importance of having multiple confluence that are confirming your bias or your narrative or your trade setup. The more confluences you have, the better. Okay, but these have to be real confluences. If you're just using, indicators, sometimes having too many on the chart are just going to make your strategy worse, such as having different moving averages and including RSI and stochastic and putting Fibonacci on there and candlestick patterns. And if you're using too many of these retail, um, you know, indicators and concepts, then most likely you're making your strategy worse. But the kind of confluences I'm talking about here is smart money confluences, mainly ICT's concepts, which are relevant, and they're one of those things that the more you have, the more likely your trade is going to pan out. It's not the same as retail, where the more things you have on your chart, the more things that you're considering are most likely going to make your trades worse and decrease your win rate. Okay, so I'll highlight what I have going on here and analysis that I've had and been having. Um, I'll start with how I would do my analysis. I start on the higher time frame, and I will always start on the dollar index. This is a new chart, so I do not have all my annotations on here, but basically I'm expecting higher prices on the dollar. This is a weekly time frame, and we see that we have a weekly BC here, and in here there's a more refined gap on the 3-day, which I'm looking for. It's one of my signature gaps as well. So on this 3-day time frame, we see a good reaction, a good rejection coming into this order block here, and I have the bias that we're going to higher prices to fill some inefficiencies on the monthly time frame, basically, that can be seen on that time frame. Just to note, we also have some equal highs built up here, which I like. To me, that is smart money engineering liquidity and building sentiment for their next leg up. Okay, so if I go into the monthly, you can see it a little bit more clearly. We see more inefficiencies above this high. We had a sell side imbalance, buy side inefficiency here that got traded right through. And we see it now coming back into that and likely using that as support. So that's one confluence for the dollar index. And of course, on the weekly and the 3-day, we have more gaps being created. That's another confluence. Seasonally for the dollar index, for the dollar, May is more bullish for the dollar. There's usually more upward movement um, historically over the decades. So bullish prices for the dollar. Dollar came into our POI. Now we see a good reaction, and now we're looking for either longs on the XXX dollar pairs or the dollar XXX pairs. We'll be looking for we'll be looking for longs on the dollar XXX pairs. And I don't know why I'm saying XXX, but the dollar foreign currencies rather than the foreign currency dollar. So we're expecting higher prices on the dollar, then for euro, pound, Australian dollar, we are looking for lower prices because dollar is in the second part of the name. If dollar is in the second part of the symbol, if dollar is in the first part of the symbol, obviously we'll also be looking for long because that would mean stronger dollar. So yeah, we go back to let's go back to the weekly first. So we have that dollar bias of a bullish dollar, aka bearish foreign currencies. The DXY is also in a seasonal tendency to be stronger, so we have that on our side. So now I do my analysis on the asset that I want to trade, right? So this is the weekly time frame. We have a weekly gap that was created in here. Okay, well, let's go back to here first, right? We see a gap that got traded into. Price expanded higher, but it consolidated for quite a number of weeks and months. It came down, had a bounce, came down, and then a big expansion up. So at this point, all the traders that were patient in here, waiting a number of months, are now thinking that, okay, we're going on a breakout. Those that thought we of going short were now too scared because of this expansion, and breakout traders are trying to get in on this move to potentially go higher, way higher, maybe take out this high. It doesn't matter, right? So on 4th of March, this is the weekly chart, we had expansion up, and on the 11th of March, we had expansion down. So on the 8th of March, if we go down to the daily, was the last high, and on that day we had NFP Friday, okay, and then we started moving lower from there, which is good, which goes together with our bias for the dollar. And we see a gap get created, somewhat of a breaker as well. Price trades into it once, twice. Just to know, it trades into it once, creates more equal lows below here. If you can't see it, all these wicks, they're relatively equal, and this is a draw on liquidity. Okay, price wants to go back to these levels, so we see it come back up into it again. This is on 8th of April. I'm not sure what news was on the 8th of April, but most likely it was a sort of news event. If it wasn't, then it's okay. But I know that price coming into here was, I think, also NFP and PMI. I'll go through that in a little bit. Okay, so anyway, price comes into here, expands down, and now we start moving back. It comes into this weekly order block quite nicely. Looks like the wick doesn't even go through the, stops dead in its tracks right in the middle. Yeah, which is, algorithmic signatures, right? So we see price come back into this area, and that's the weekly time frame. Let's go to the daily and see what happened, right? Price went up. It kind of chopped around for a few days. Kind of the same thing we were seeing here on the weekly. Okay, but if you go down to a lower time frame, we'll be able to see it a bit more clearly. Let's go down to the 4-hour. We see price chopping upwards, and it starts to break down, but now it starts to move up again. To me, this is just, to confuse traders who are just basically looking at candles and trying to get in on that move, right? An up candle, they want to jump in and go long, or down candle, they're going short or getting scared out of their longs. So I was anticipating this because there's nice imbalances up here and a nice breaker up here as well that also can be seen. It was the gap on the DXY, and on the euro you get something nice as well. So yeah, that's another thing. Those pairs that move together as well is good to analyze and adds that extra bit of confluence. So during NFP, PMI, NFP brought it up, PMI dropped it down. Price started going up again, just to fill in some imbalance. It stopped dead in its tracks over here above this weekly gap, and then started moving lower. Nice, there's a gap here, price came into it, moved lower. There's a gap here, price came into it, moved lower. All following what I've been looking for. And now we are here, right? So where are we going? Let's go back to the weekly first. So for me, if the dollar were going higher to that monthly gap, then the pound would most likely be drawn to these areas and PD arrays on the higher time frames, which you can see more clearly on the euro and the dollar. But yeah, if the dollar is gaining such strength, then the pound should fall as well. So Go back to the weekly. We have the liquidity taken out, expansion, fair value gap, breaking through this inversion fair value gap. Okay, so at this point, when price broke down and started to trade back up, it also created a sell side imbalance, buy side inefficiency. So we have two confluences now in terms of gaps, an inversion fair value gap and a SIBI as well. All right, and we also have the nice formation of quite a clear market maker sell model distribution happen. So we have a consolidation, manipulation to take out liquidity, displacement lower with a gap. You could consider this a low risk sell. There's probably a low risk sell as well in here. Redistribution, expansion, and redistribution again in this area. Okay, back to an order block, which is quite classic of a market maker sell model. If you do not know what that looks like, there are plenty of images and screenshots that people have taken online. What I like about this is that the bodies are very cleanly respecting the midpoint of this gap. You see over here, the bodies use that as support for the bodies. Sorry, the bodies use the consequent encroachment of the gap as support. And here, almost exactly to the same price, using it as resistance. So this is good. This is good, and what I like to see. The red folder news was the manipulation here, NFP more over here as well, inducing buyers into the market before wrecking them. So there's so many confluences going on, all right, and there's a potential for such a big move. Let's say from the midpoint of this gap to where it is now is already almost about 70 pips, all the way to the bottom of the swing low, 250. And if you can hold long enough to target here, potentially 500, right? Which is a decent amount of pips, quite respectable. It's going to take a while to get there, but in these turbulent times, just manage your risk accordingly if you were to get into a trade. Nothing's for sure, nothing's confirmed. You know, we have elections this year in the United States, which is usually quite impactful. There's wars going on, pandemics, viruses, aliens. So the market could move from any point to any point almost instantaneously. So after I've done my analysis on the weekly, it seems that everything's working out. There was a nice trade in here as well, and this is just a continuation. But we can see if this candle leaves open this gap, it could be a possible area where price may trade into, or it just may be continue expanding lower. We see a gap here as well, which can be used as a take profit target and a drawn liquidity for price. Let's go back down. Let's go lower to the 4 hour. Okay. See an order block here, a gap with this breaker here. So price could come into here, which would be the inversion fair value gap again. No, sorry. This is the SIBI over here. We can always put the midpoint. Where is it? Here. Middle line. Consequent encroachment, which is nicely right in the middle of this gap as well. So we could see on the 4 hour price trade into here. We do not want to see the bodies close higher than this gap. Okay, because the bodies tell the story. Wicks do the damage. I posted a video on that quite recently, either on TradingView or YouTube or both. So ideally, if price comes into here, we do not want to see the bodies close above the midpoint. It could do close above the consequent encroachment, but we don't want that, right? It would show us that it's possibly gaining strength and maybe be used as a inversion fair value gap. So the best looking ones close below the mean threshold and the lower quadrant. Although we see an order block here, we may see a wick higher, maybe into the midpoint of this up close candle's wick, or into the body. And I guess as high as I would like to see is in this midpoint here. So when you see some crazy wicks, most of the time they're due to very high impact news. But the most important thing is the body, where the body's closed. So the wicks can do crazy things. For example, you see, I guess you could consider this an order block. The bodies don't close below, but you see a wick even taking out the low. So at that point, seeing a black engulfing candle, which is my down close candle, you may be thinking we're now bearish, right? If I were to make this completely black, that's one reason why not to watch the candles too much. Okay, although this is the 4 hour. At that point, yeah, it may be quite scary seeing price all the way down here. But seeing that, it looks strong, right? It starts to move up, down, chip chop, then lower. So this is also, I guess if you hold here to here, it's about midpoint of a range, equilibrium. So that's a good signal as well. Confluence for your sell to work out. Creating this relative equal lows here. Very nice. Just for the people who are too bored to listen to me, I'll just put this here. With the possibility of a wick coming into here, right? If we just make the wick smaller and remove the arrow, that's a possibility. And a likelihood, but we also have this gap here. Okay. So yeah, that's all. I'll update this analysis once it has panned out. Okay. Regarding where should I put my stop loss? This is the 4 hour time frame. If you're just getting on the 4 hour and not doing any additional analysis for a higher risk to reward, you could probably put it at this high. If you were to get in somewhere here, that should be pretty safe. And target is low. Take partials here or your full position. It's always recommended once you take out a pool of liquidity and scale some off as it moves lower if you're swing trading. Okay, but if you get in a lower time frame, maybe you can do more intraday analysis, which is slightly different but quite similar in terms of PD arrays, and perhaps you can catch a better RR. Okay, but yeah, always leave some room, some space for your position to breathe, because the more precise you try to be or the higher RR, expect a lower win rate. So yeah, it depends how much your psychology can take, and hopefully the strategy that you've tested. All right, till next time, peace out.